Inflation is finally cooling off. Good news for your wallet, but don't celebrate just yet. The Consumer Price Index is rising more slowly, thanks largely to falling energy prices and a stabilizing housing market. Cheaper fuel and moderating rents are helping, making everyday life a bit less expensive. But here's the catch. Some experts warn this relief could be temporary. Retailers are slashing prices to clear out excess inventory. But once that's gone, prices could jump again. So while things look better now, the risk of inflation roaring back isn't off the table. The Federal Reserve is watching closely, and so should you. Enjoy the breather, but stay alert. This story isn't over. The next few months will tell us if this is a real turning point or just a pause. The bond market may seem boring, a place where financial institutions quietly trade debt, but right now, it's the epicenter of financial drama. It's a critical juncture that demands our attention, a situation far more exciting and, frankly, concerning than many realize. Rising interest rates have hammered bond prices, creating a ripple effect throughout the financial system. This isn't just an abstract economic concept, it has real-world consequences, hurting everyone from pension funds which rely on stable bond returns to meet their obligations to retirees to individual investors who may see the value of their bond holdings decline and their overall investment portfolios take a hit. Banks, loaded with government bonds as a supposed safe haven, are feeling the pain. Their perceived stability is now being tested. Lower bond values mean weaker balance sheets, eroding their capital base and potentially limiting their ability to lend. This has far-reaching consequences. Remember the recent regional banking crisis? It sent shockwaves through the financial world. Falling bond prices played a big role, exposing vulnerabilities in their balance sheets and triggering a loss of confidence. The government isn't immune either. It's deeply intertwined with the bond market. Higher yields mean it costs more to borrow, increasing the national debt and putting pressure on future budgets. So more of your tax dollars go to interest payments, leaving less for essential services like education, infrastructure, and healthcare. This squeeze affects everything. It's a systemic issue with widespread implications. Bank stability, which is crucial for a healthy economy, government spending, which shapes our society, and even your investments, which are meant to secure your future. The bond market's troubles are a slow-moving problem, a creeping crisis that unfolds gradually, but they're getting bigger every day, accumulating into a potentially significant threat to the financial system. If rates stay high and the Federal Reserve maintains its hawkish stance, expect more pressure on banks and the federal budget, leading to difficult choices and potential economic headwinds. Keep an eye on this space, monitor the bond market closely and stay informed about its developments. It's more important than ever to understand what's happening in the bond market and how it might affect you. What happens in bonds doesn't stay in bonds. It's not an isolated event. It ripples through the whole economy, impacting everything from interest rates to inflation to job growth. America's national debt is ballooning at an alarming rate, reaching levels unseen in recent history. The sheer magnitude of this debt is a cause for concern, casting a shadow over the nation's financial future. And higher interest rates, implemented to combat inflation, are now making it much more expensive to manage this ever-growing debt. Each rate hike adds billions to the annual interest burden. The government is now spending hundreds of billions, diverting funds from crucial programs and investments, soon to be $1 trillion, just to service the interest on its debt. This escalating cost is unsustainable in the long run. This is money that could be used for infrastructure, education, or research, but instead, it's going towards interest payments. This creates a vicious cycle, a dangerous feedback loop that threatens to destabilize the economy. More debt means higher interest costs, as investors demand a greater return for lending to a heavily indebted nation, which means even more borrowing is needed to cover those rising interest payments, further exacerbating the problem. The real fear? What happens if this cycle continues unchecked? If global investors lose faith in U.S. debt and begin to sell off their holdings of U.S. Treasury bonds, the dollar could plunge, losing its value on international currency exchanges, forcing rates even higher to attract investors and defend the currency, sending inflation soaring and eroding purchasing power. That would hit everything from imports, making goods more expensive for consumers, to your savings, as the value of your assets declines in real terms. For decades, the dollar's dominance as the world's reserve currency has protected us from the worst consequences of our debt, but that can't be taken for granted forever. The global economic landscape is shifting, and new challengers are emerging. The risk of a debt spiral is real and growing, demanding immediate attention and responsible fiscal policies. The clock is ticking, and decisive action is needed to avert a potential crisis. And the world is watching, assessing the United States' ability to manage its financial affairs. If confidence cracks, and investors lose faith in the U.S. economy, the fallout could be severe, triggering a global economic downturn. This is a problem we can't afford to ignore. The time for responsible fiscal management is now. The Federal Reserve is walking a tightrope fighting inflation without tipping the economy into recession. Tariffs complicate things, making goods more expensive and pushing prices up just as the Fed tries to cool inflation. Every Fed statement is scrutinized for hints about their next move. They're cautiously optimistic inflation is easing, but the job isn't done. The labor market remains strong, but new tariffs or shocks could force the Fed to keep rates high. If inflation keeps falling and growth slows, rate cuts could come later this year. That would boost markets and ease borrowing costs. But if prices spike again, more hikes are possible. The Fed's decisions in the coming months will shape jobs, investments, and the economy. Stay tuned, this balancing act is far from over. Now, let's talk about the bears, those investors and analysts who believe the extended bull run in the stock market is losing steam. They're the ones bracing for a potential downturn, carefully analyzing economic indicators and corporate performance for signs of trouble ahead. These are the individuals and firms who think the stock market's party is ending, and they have some compelling reasons for their pessimism. They're not just guessing, they're basing their views on fundamental factors that could trigger a significant market correction. Companies are warning of weaker earnings, citing factors like inflation, supply chain disruptions, and decreased consumer spending. This is a crucial signal because earnings are the lifeblood of stock prices, and economic growth is slowing. The pace of expansion is decelerating, raising concerns about a potential recession. This slowdown can impact corporate profitability and investor sentiment. High interest rates are starting to bite as the Federal Reserve continues its efforts to combat inflation. These higher rates increase borrowing costs for businesses and consumers alike, making it tough for stocks to keep climbing. Higher rates reduce the attractiveness of stocks compared to bonds and other fixed-income investments. Valuations are stretched. Many stocks are trading at historically high price-to-earnings ratios, suggesting they may be overvalued. Investors are paying a premium, betting on continued strong growth to justify these high valuations for future growth that may not materialize. If companies fail to meet these lofty expectations, stock prices could suffer. Years of cheap money fueled a bubble, creating an environment where asset prices were artificially inflated by low interest rates and easy monetary policy. And now, with rates higher, the air could be coming out. The era of easy money is over, and the market is adjusting to a new reality. Corporate debt is another worry, as many companies took on significant amounts of debt during the low interest rate period. Companies must refinance at higher rates, increasing their interest expenses and putting pressure on their bottom lines. Squeezing profits. This can lead to reduced investment, hiring freezes, and even layoffs. If the economy stumbles and a recession occurs, the impact on corporate earnings could be severe. Defaults and bankruptcies could follow, further destabilizing the market and the broader economy. The bears see a shaky foundation, with several factors converging to create a potentially challenging environment for stocks. Slowing growth, expensive stocks, making it difficult to justify current market levels, and rising debt. These factors, combined, paint a concerning picture for the future of the stock market. They warn a correction is overdue. After years of gains, a period of consolidation or even decline may be necessary to rebalance the market. It's a case for caution, urging investors to carefully consider the risks and potential downsides before making investment decisions. Don't ignore the warning signs. Paying attention to these indicators can help you protect your portfolio and make informed choices. The market may be due for a reality check. A period of volatility and uncertainty could be on the horizon, requiring investors to be prepared for potential losses. But the bulls have their case too. Inflation is cooling and the Fed could soon cut rates. Great news for stocks. Corporate earnings, while cautious, remain strong, showing resilience. Companies are adapting, becoming more efficient and tech-savvy. There's a mountain of cash on the sidelines, ready to jump in if the outlook brightens. If trade tensions ease or technology sparks new growth, markets could rally hard. The bulls believe a little good news could trigger a big surge. In a world full of pessimism, optimism can be a powerful force. Don't count out a comeback just yet. So where does that leave us? The market is at a crossroads. Risks are real sticky inflation, bond market stress, and heavy debt. But there are also opportunities, moderating prices, strong profits, and potential Fed rate cuts. The tug of war between bulls and bears is intense and the outcome is uncertain. This isn't the time for big gambles or complacency. Stay disciplined, know what you own, and keep your eyes on the data. The next few months will be critical. Watch inflation, earnings, and the Fed. Whether you're bullish or bearish, stay nimble and informed. Don't get scared out of good positions, but don't be afraid to take profits. The market demands your attention now more than ever. The game is on. Are you ready?